Silver just shattered $97. In the next few hours, it could breach $100. But this isn't just another price spike. 4 economic forces are converging right now. Forces that haven't aligned like this in over 4 decades. Central banks are moving in silence. Industrial demand is outpacing supply by margins we've never seen. And the financial system is showing cracks most people aren't paying attention to. If silver hits $100 tonight, what happens next could reshape portfolios, industries, and entire economies. The question isn't if you should pay attention, it's whether you're already too late. Welcome to John Analyst, where we cut through the noise and deliver the analysis that matters. Now, if you've been watching markets long enough to remember when information wasn't instant, when decisions required patience and real insight, then you know the value of a channel that doesn't waste your time. Do me a favor, hit that subscribe button, not because I'm asking, but because the next few months are going to separate those who saw it coming from those who didn't. And before we dive deeper, drop a comment below. Tell me where you're watching from. Are you in the States, Europe, Asia? I want to know who's paying attention right now, because what's happening with silver is happening everywhere. Let's get into it. At precisely 9:47 a.m. Eastern Time, silver crossed a threshold that most analysts thought was still months away, $97 per ounce. Not a gradual climb, but a surge that caught even seasoned traders off guard. Within minutes, trading volumes spiked to levels not seen since the 2011 rally, when silver briefly touched $49 before collapsing back to earth. But this time, something is different. The movement isn't driven by retail speculation or Reddit forums pumping precious metals to the moon. This is institutional, strategic, and far more calculated. To understand what's happening right now, we need context. Silver has spent the last decade trapped in a range, moving between $15 and $30 per ounce, frustrating investors who remembered its explosive 2011 peak. For years, the metal languished, dismissed as a relic, overshadowed by Bitcoin, tech stocks, and growth equities that promised faster returns. But beneath the surface, fundamentals were shifting. In 2020, when the pandemic shut down economies worldwide, silver briefly spiked to $29, then retreated. In 2022, as inflation roared to 40-year highs, silver pushed toward $26, then stalled. Each rally failed to sustain momentum. Each pullback reinforced the belief that silver was dead money. Until now. The move from $80 to $97 happened in less than 3 weeks. That's a 21% gain in a market that typically moves in single-digit percentages over months, and the velocity is accelerating. What makes this surge historically significant isn't just the price, it's the structure beneath it. In 1980, when silver hit $50, it was driven almost entirely by the Hunt brothers, a speculative corner that eventually collapsed under its own weight. The market was manipulated, artificial, unsustainable. In 2011, the rally was fueled by post-financial crisis fear, central bank money printing, and a wave of retail buying through ETFs. But when that fear subsided, and when speculative positions unwound, silver crashed 45% in less than 5 months. This time, the foundation is different. Industrial demand for silver has transformed from a secondary factor into the primary driver. Solar panel production alone consumed over 140 million ounces of silver last year, a figure that's projected to double by 2027. Electric vehicles require roughly 1 ounce of silver per car, and global EV production is scaling exponentially. 5G infrastructure, medical devices, electronics manufacturing, all require silver in quantities that didn't exist a decade ago. And here's the critical point. While industrial demand has been climbing steadily, mining production has been flat. The world's largest silver-producing nations, Mexico, Peru, China, are not expanding output fast enough to meet consumption. Primary silver mines are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. And when base metal prices are weak, silver production suffers regardless of silver's price. This creates a structural deficit. More silver is being consumed than mined, and the gap is widening. In a normal commodity market, prices rise, production increases, and balance is restored. But silver isn't a normal commodity anymore. It's caught between two worlds. The industrial world that needs it for green energy and technology, and the monetary world that views it as a store of value when fiat currencies weaken. And right now, both worlds are pulling in the same direction. Central banks globally have printed over $25 trillion since 2020. Real interest rates, adjusted for inflation, remain negative in most developed economies. The US dollar, despite its reserve status, has lost purchasing power at rates not seen since the 1970s. When currency debasement accelerates, hard assets rise. Gold has already surged past $3,000 per ounce. Silver is simply catching up, but there's something else happening beneath the price action. Something that explains why $100 isn't just possible tonight, but likely. The futures market, where most silver trading occurs, is showing signs of stress. Open interest is at record highs, meaning more contracts are outstanding than ever before. But physical inventory available for delivery, the actual metal backing those contracts, is shrinking. The COMEX, the primary exchange for silver futures, holds roughly 300 million ounces in registered inventory. That sounds like a lot until you realize open interest represents claims on over 900 million ounces, a 3-to-1 ratio of paper claims to physical metal. And when traders start demanding delivery instead of rolling contracts, that ratio becomes a problem. We've seen this movie before in other commodities. When paper markets decouple from physical reality, the result is always the same: violent price dislocations, short squeezes, and a scramble for real metal. Silver just hit $97, but the forces pushing it higher aren't slowing down. They're accelerating. And the question every serious investor should be asking right now is not whether silver will hit 100. It's what happens when it does. There's a pattern that emerges in markets just before something breaks. Not the kind of break that makes headlines for a day, but the kind that redefines how an entire asset class is valued for years to come. Silver is displaying that pattern right now. And while most commentators are focused on the price, the real story is happening in 4 distinct corners of the global economy, each operating independently, yet converging at precisely the same moment. When forces like these align, the result isn't gradual change, it's systemic disruption. Let's start where most analysts aren't looking: the industrial demand transformation. In 2015, solar panel manufacturers consumed approximately 76 million ounces of silver annually. By 2024, that number had climbed to 161 million ounces. This year, projections suggest it will exceed 200 million ounces. That's not growth, that's exponential acceleration. And it's not optional. Every major economy has committed to net zero carbon targets by 2050. The European Union plans to install 600 gigawatts of solar capacity by 2030, up from 260 gigawatts today. China is adding solar capacity faster than the rest of the world combined, over 210 gigawatts added in 2023 alone. The United States, through the Inflation Reduction Act, has allocated hundreds of billions in subsidies for renewable energy infrastructure. Each megawatt of solar capacity requires approximately 11 kilograms of silver. Do the math. The solar industry alone will consume more silver in the next 5 years than was mined in the entire decade of the 1990s. But solar is just one piece. Electric vehicles are the second accelerant. A traditional internal combustion engine vehicle contains roughly 15 to 28 grams of silver in its electrical systems. An electric vehicle, depending on the model, contains 25 to 50 grams. Hybrid vehicles use even more, some models exceeding 80 grams per unit. Global EV sales reached 14 million units in 2023. By 2030, that number is projected to hit 45 million units annually. That's an additional 100 tons of silver demand every year, just from passenger vehicles. Add commercial EVs, buses, and electric trucks, and the figure climbs even higher. Then there's 5G infrastructure. The build-out of next-generation wireless networks requires silver in base stations, antennas, and circuit boards at densities far exceeding 4G technology. China has already deployed over 3 million 5G base stations. The United States, Europe, and India are racing to catch up. Each base station contains between 20 and 40 grams of silver, multiplied across millions of installations globally. Medical technology is another quiet consumer. Silver's antimicrobial properties make it irreplaceable in wound dressings, surgical instruments, and medical coatings. As healthcare spending rises globally, particularly in aging populations across developed nations, medical silver demand continues its steady climb. And here's the problem. None of this demand is discretionary. It's not speculative buying that disappears when sentiment shifts. It's structural, baked into manufacturing processes, mandated by government policy, and accelerating regardless of silver's price. Now let's shift to the second force: monetary policy consequences. Since 2020, the world's central banks have expanded their balance sheets by over 25 trillion. The Federal Reserve alone increased its holdings from 4 trillion to over 9 trillion at the peak. Even after quantitative tightening, the balance sheet remains bloated by historical standards. The European Central Bank, the Bank of Japan, and the People's Bank of China have followed similar trajectories. This isn't a conspiracy theory. It's publicly available data. And the consequence of that expansion is straightforward: more currency units chasing the same amount of real assets. Real interest rates, the nominal rate minus inflation, have been negative across most developed economies for the better part of 4 years. When cash loses purchasing power faster than it earns interest, capital seeks alternatives. Gold has been the primary beneficiary, surging past $3,000 per ounce as central banks themselves have become net buyers. But silver, historically, tends to outperform gold during periods of monetary instability. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has averaged around 60 to 1 over the past century. In 2020, that ratio spiked to 120 to 1, meaning silver was historically cheap relative to gold. Today, even with silver at $97, the ratio sits near 31 to 1. If that ratio reverts to its historical average, silver still has significant room to run, and institutional investors are starting to notice. Hedge funds, pension managers, and sovereign wealth funds are reallocating capital into hard assets as a hedge against currency debasement. The third force is less visible but equally critical: supply chain disruptions. Silver mining production has been essentially flat since 2016, hovering around 820 to 850 million ounces annually. Despite prices rising, production hasn't followed. Why? Because silver isn't typically mined on its own. Roughly 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. When base metal prices are weak, miners reduce operations, and silver output falls regardless of silver's price. Ore grades are declining across major producing regions. Mexico, the world's largest silver producer, has seen average ore grades drop nearly 30% over the past 2 decades. It now takes significantly more ore to extract the same amount of silver. Peru, the second largest producer, faces similar challenges, plus political instability and regulatory pressures that have delayed new projects. China, traditionally a major producer, has scaled back operations as environmental regulations tighten. And there's a timing problem. Even if silver prices stay elevated, it takes 7 to 10 years to bring a new major mine online. Exploration, permitting, construction, all require time and capital. The supply response won't arrive for years. Meanwhile, demand is accelerating now. And the fourth force, the one that could trigger the move to $100 tonight. Financial systems stress indicators, derivatives exposure in precious metals, markets has reached levels that should concern anyone paying attention. The notional value of silver derivatives held by major banks exceeds $100 billion. Small price moves create massive margin calls and collateral demands. When those positions unwind, volatility explodes. We're seeing early signs of that now. And if history is any guide, what comes next isn't a correction, it's a reckoning. There are moments in markets when time compresses, when weeks of typical movement happen in hours, when carefully constructed positions unravel in minutes, when the word unprecedented stops being hyperbole and starts being the only accurate description. Silver is entering one of those moments right now, and the question isn't whether it will reach $100. The question is, what sequence of events is already in motion that makes tonight different from any other night in the past 14 years? Because something is happening beneath the surface that most traders won't see until it's too late. Let's start with what's visible. The technical powder keg at 4 out p.m. Eastern time today, a significant tranche of silver options contracts expire. These aren't small retail positions. We're talking about institutional grade contracts, representing tens of millions of ounces, clustered around strike prices between $95 and $105. When options approach expiration, dealers who sold those contracts must hedge their exposure. If silver is trading below the strike price, they remain unhedged. But as silver rises above those strikes, particularly in rapid succession, dealers are forced to buy futures contracts to cover their risk. This creates what traders call a gamma squeeze. The higher silver goes, the more dealers must buy, which pushes the price higher still, forcing even more buying. It's a feedback loop. And right now, with silver at 97 horse, the next major strike cluster sits at $100. If that level breaks tonight, the mechanical buying from options dealers alone could add 3 to 5 hours to the price within hours. But that's just the visible part. The invisible part is more dangerous. Short interest concentration. According to the latest Commitment of Traders report, commercial traders, primarily large banks and trading houses, and now those positions are deep underwater. Every dollar silver rises costs short sellers billions in mark-to-market losses. At some point, the pain becomes unbearable. Shorts begin covering, buying back contracts to close positions, which drives prices higher, triggering more short covering. This is how short squeezes happen, and the early signs are already appearing. Open interest, the total number of outstanding futures contracts, has started declining even as prices rise. That's unusual. Typically, rising prices attract more speculative interest, and open interest expands. When open interest falls during a price surge, it suggests forced liquidation, shorts, covering, positions unwinding. And once that process starts, it accelerates. Now, let's add the geopolitical layer, the unspoken moves. 3 days ago, China's State Administration for Market Regulation announced new standards for silver imports. The announcement received almost no coverage in Western media, but the implications are significant. China consumes nearly 200 million ounces of silver annually, roughly 20% of global supply. Any policy shift that affects import flows ripples through global markets. The new standards effectively tighten approval processes, slowing the flow of refined silver into Chinese markets. Whether this is intentional market manipulation or bureaucratic adjustment is irrelevant. The effect is the same: a tighter physical supply in the world's second largest economy. Then there's India. India's government has been quietly reducing import duties on silver over the past 18 months, part of a broader push to encourage precious metals investment among its population. Indian silver imports have surged 40% year over year. During wedding season, which peaks in the coming months, Indian physical demand typically spikes even further. That's millions of ounces pulled from global supply and locked into jewelry and household savings. It doesn't come back to the market. Meanwhile, whispers are circulating in London's bullion markets about delivery delays. Not failures, not yet, but delays. Orders that normally settle in 48 hours are taking 5 to 7 days. Refineries are operating at capacity, struggling to meet demand for physical bars and coins. This is what happens when paper markets begin converging with physical reality. The frictions appear slowly, then all at once. And here's the part that should concern anyone holding short positions or underestimating this move: the exchange inventory problem. The COMEX, the primary futures exchange for silver, reports its inventory daily. As of this morning, registered inventory, the metal available for delivery against futures contracts, stood at 287 million ounces. That sounds adequate, until you look at open interest. Open interest currently sits at approximately 180,000 contracts. Each contract represents 5,000 ounces. That's 900 million ounces of paper claims against 287 million ounces of physical metal, a ratio of 3.1 to 1. Now, under normal circumstances, most futures contracts settle in cash or are rolled forward. Only a small percentage demand physical delivery. But circumstances aren't normal right now. What happens if just 10% of contract holders demand delivery? That's 90 million ounces, roughly 1/3 of available registered inventory. What happens if 20% demand delivery? The exchange runs out of metal, and we've seen this before in other commodities. Nickel in 2022, when the London Metal Exchange had to halt trading and cancel trades after a short squeeze, sent prices up 250% in 2 days. Palladium in 2021, when physical shortages sent prices to all-time highs despite weak industrial demand. Silver's market structure is more fragile than either of those, and the stress is building. The psychological threshold. Round numbers matter in markets, not because they have intrinsic significance, but because human psychology assigns them meaning. $100 per ounce is one of those numbers. It's a headline, a milestone, a trigger for media coverage and retail attention. When silver crosses $100, it won't just be financial news. It will be mainstream news. And that brings a new wave of buyers, people who weren't paying attention at $80 or $90, but who suddenly feel compelled to participate at $100. This is the FOMO effect, fear of missing out. It's irrational, but it's powerful, and it amplifies moves that are already in motion. History shows that psychological thresholds often act as magnets. Prices accelerate into them, pause briefly, then explode through them as pent-up demand is unleashed. Gold did this at $2,000, then again at $2,500, and again at $3,000. Silver is approaching its own moment. The timeline. Options expiration hits at 4 Aus p.m. Eastern. Asian markets open in less than 6 hours. If silver is trading above $98 when Tokyo opens, momentum intensifies. Chinese markets follow 2 hours later. By the time London opens tomorrow morning, if $100 has been breached, European buyers enter the fray. This is how cascades happen. One market hands off to the next, each adding fuel to the move. And by tomorrow afternoon, the market won't look anything like it does right now. So the question isn't whether silver hits $100 tonight. The question is whether you're positioned for what happens next. Because the forces in motion don't stop at round numbers. They stop when something breaks. Let's assume silver breaches $100 tonight. Not as speculation, but as a working assumption for strategic planning. Because the real risk isn't being wrong about the timing. The real risk is being unprepared for what follows. Markets don't move in straight lines, and silver, historically, moves in violent arcs. When $100 breaks, 3 scenarios become possible. The first scenario, a brief consolidation, where silver touches $100, retreats to $95, and then builds a base before the next leg higher. This is the orderly scenario, the one that allows participants to adjust positions, manage risk, and respond rationally, it's also the least likely. The second scenario, a melt-up, where $100 becomes a launch pad rather than a ceiling. Silver doesn't pause. It accelerates. $105 within days. $115 within weeks. Momentum feeds on itself, driven by short covering, options hedging, and panic buying from those who waited too long. This scenario has historical precedent. In early 2011, silver rose from $26 to $49 in less than 4 months. The velocity was breathtaking and unsustainable. But for those positioned correctly, the gains were life-changing. The third scenario, systemic disruption, where physical shortages force exchange interventions, trading halts, contract settlements in cash rather than metal, regulatory emergency measures. This is the scenario nobody wants to talk about, but it's the one that keeps exchange risk managers awake at night. Because if the paper market decouples from physical reality, the consequences extend far beyond silver. It calls into question the integrity of commodity futures markets generally, and that affects everything from energy to agriculture to base metals. So how does one prepare for uncertainty across multiple potential outcomes? Let's break it down by stakeholder category. For current silver holders, if you're holding physical silver, bars, coins, or allocated storage, your primary considerations are liquidity and security. Physical metal has no counterparty risk, but it has liquidation friction. Selling 10 ounces is easy. Selling 10,000 ounces at optimal prices requires planning. Dealers need time to source buyers. Premiums fluctuate based on product type, and large transactions attract attention. If you're holding silver through ETFs or futures contracts, your exposure is different. ETFs like SLV are backed by physical metal, but redemption processes during extreme volatility can lag. Futures contracts provide leverage, but they require margin maintenance. If silver gaps higher overnight, margin calls arrive before market open. And here's the critical point. In volatile markets, liquidity disappears precisely when you need it most. Bid-ask spreads widen, order execution slows, and emotional decision-making takes over. The time to plan exit strategies isn't during the chaos, it's now, for those not yet positioned. Chasing momentum at $100 is a dangerous game, but ignoring a structural shift is equally dangerous. The question isn't whether to buy silver at elevated prices. The question is what role silver plays in a diversified risk management strategy. If the thesis is correct, that industrial demand is structural, monetary policy remains inflationary, and supply constraints are real, then $100 silver isn't expensive. It's a transition point. But timing matters. Entering during a parabolic spike invites drawdown risk. Waiting for a correction that never comes invites opportunity cost. The strategic approach isn't all in or all out. It's scaled entry, position sizing relative to portfolio risk tolerance, and clear definition of investment thesis versus speculation. Are you buying silver as an inflation hedge? Then your time horizon is measured in years, not weeks. Are you trading momentum? Then your risk management must be surgical with defined stops and profit targets. Mixing these two approaches is where most participants fail. For business decision makers, if your business consumes silver as an input, solar manufacturers, electronics producers, medical device companies, the post-100 environment presents operational risk. Input cost volatility doesn't just affect margins. It affects supply chain stability, contract negotiations, and competitive positioning. Companies that hedged their silver exposure 6 months ago are insulated. Those that didn't face difficult choices: pass cost to customers and risk losing market share, absorb costs and compress margins, delay production and risk delivery failures. None of these options are attractive. And here's the longer-term consideration. If silver sustains elevated prices, substitution becomes economically viable in some applications. Research into silver alternatives in solar cells, conductive inks using copper or graphene, antimicrobial coatings using alternative compounds. These technologies exist, but haven't been economically competitive. At $100 silver, the calculus changes. But substitution takes time, years, not months. In the interim, businesses that depend on silver must navigate a higher cost environment. For the financial system, the banking sector's exposure to precious metals derivatives is not trivial. Major institutions hold billions in notional value across gold and silver contracts. When prices move violently, mark-to-market losses accumulate. Most banks have risk management protocols, position limits, stress testing, but protocols are designed for normal volatility, not for dislocations that occur once a decade. If silver's move triggers margin calls that cascade into other positions, if counterparty failures begin, the contagion risk extends beyond precious metals. This is why regulators watch commodity markets closely during periods of stress, and why exchange interventions, while rare, are not without precedent. The London Metal Exchange's nickel debacle in 2022 demonstrated that exchanges will protect their members, even if it means canceling trades and suspending price discovery. Silver holders should understand this risk. In extreme scenarios, paper contracts may not settle as expected. The strategic framework moving forward. Regardless of where silver goes in the next 24 hours, the underlying dynamics don't disappear. Industrial demand isn't reversing. Monetary policy isn't tightening aggressively. Supply constraints aren't resolving quickly. These are multi-year forces. What changes is sentiment, or positioning, and market structure. And that creates opportunities for those who understand the difference between signal and noise. The signal is structural deficit. The noise is daily price movement. Silver at $100 tonight would be noise. Silver at $120 in 6 months would still be noise. What matters is whether the fundamental thesis remains intact. And right now, it does. The warning. Complacency is the enemy of preparation. Those who assume this is just another commodity rally, another speculative bubble that will deflate once sentiment shifts, are ignoring the evidence. This isn't 2011. The drivers are different, the market structure is different, and the macroeconomic backdrop is different. That doesn't guarantee higher prices, but it does guarantee volatility. And in volatile environments, the unprepared get crushed, not because they were on the wrong side of the trade, but because they didn't have a trade at all. Final assessment. Silver's move toward $100 is not an endpoint. It's an inflection point, a marker that something fundamental has shifted in how this metal is valued, consumed, and perceived. For the business community, this is a signal to reassess supply chains, input costs, and hedging strategies. For investors, this is a reminder that hard assets matter when monetary confidence erodes. For the financial system, this is a stress test of market structure and derivatives exposure. And for those watching from the sidelines, the lesson is simple. Markets don't wait for permission. They don't pause for reflection. They move, and those who adapt survive. Those who don't learn expensive lessons. Silver just crossed $97. By the time you finish reading this, it may have already crossed $100. And the question you'll be asking tomorrow is whether you were ready.